At Montgomery Global, our global equity strategies are geographically diversified across the major regions of the world. We have recently been operating with significant exposure to Europe and Asia, in addition to North America. This basic form of geographic diversification typically serves global investors well, but in times of rotations between regions, this structure can make performance more challenging. Shown on the screen is a chart that compares the performance of key equity indices by regions. The Dow Jones Industrial Index, representing US non-tech, the NASDAQ, representing US tech, the Hang Seng Index, representing Asian equities, and the Europe Stoxx 600 Index, representing European equities. What we can observe is that US equities have increased, while Asian and European equities have gone backwards. And given our material exposure to Europe and Asia, this is making our life more difficult. Our assessment of the drivers of this rotation can be simplified into two simple categories. Number one, President Trump's escalating trade war is increasing the risk aversion of global investors, especially with respect to Asian and European equities. And number two, US monetary policy, heightened risk aversion, and the expectation of a declining US trade deficit are all pushing the US dollar higher. This in turn is wreaking havoc on some emerging market economies, especially those which have significant outstanding US dollar denominated borrowings. We then make an assessment as to the persistency, or otherwise, of these drivers that have led to the equity market rotation we're currently observing. Our assessment is that President Trump has a political incentive to continue to act aggressively until the midterm elections on the 6th of November. Such tough action resonates well with his political base. Similarly, Chinese and European policymakers have an incentive not to back down prior to the midterms on the basis that the Democrats have a meaningful chance of taking back control of the House of Representatives. Such a win for the Democrats would significantly constrain President Trump's future protectionist trade measures, and a reversal of this market rotation would potentially ensue. On this basis, the Montgomery Global Research Team has assessed that the current rotation could well persist for the next 6 or 7 weeks. As such, we have systematically reduced our exposure to China. And in our Montica strategy, we have also reduced some of our US short exposure. In our other names, we are using the current weakness to add to our position. We believe this action is decisive and will serve to reduce any pain from an extended market rotation over the coming weeks. From the midterm elections and beyond, we will look to take advantage of the many market mispricings which are being created today.